Get started. March 30th. Let's see what's going on March 30th for my devotion here. Quick devotion. Here we go. I haven't read it yet, so I'm probably going to bumble a little bit. This is from Beverly Taylor, Sun City, Arizona. Monday, March 30th. My extended family immigrated to the United States during the 1800s. While recently researching county records, I found a self-published memoir by another family of pioneers and homesteaders in the same region. Anxious to learn more, I skimmed the pages and was thrilled when I discovered that my great-great-grandparents' name was in the memoir. Together they built sod houses, planted crops, raised their families, and established a house of worship on the prairie. I read that during a particular crisis, my ancestor reminded the close-knit community that God would work things together for their good, as promised in Romans 8:28. Wow. His words and firm belief spoke volumes. God was his dwelling place, his refuge. The words of Psalm 90 resonate now more than ever. I feel fortunate that more than a century ago, my ancestors, whom I did not know, trusted and believed the God I worship and trust. What a legacy of faith! I hope I can leave such a legacy. As parents, grandparents, or friends, we all have opportunities to influence the generations that follow. All right, well, a good start for our Monday afternoon now, of week 2 for Accounting Principles 2310, which is just introductory accounting, right? Or Principles 1. So what you see on the screen here is I'm just gonna flip through the PowerPoint quite quickly. It is available on Blackboard, so you're able to pick that up and review it at your leisure. So let's start off with our question for today. So we make sure we get that on Blackboard as a touch for the week. So I need you to respond to question 1. And I'm even it's actually our second slide is that answer, okay? So you see that chapter 8 is dealing with cash, fraud, and internal control. We're going to be very light on the fraud, very light on the internal control, and focus mostly on this cash, the accounting for cash. 2 things: petty cash, bank reconciliations, which is like balancing a checkbook, okay? So our question for the week is on this slide here. So the question for the first question for week 1, and the second question will be in the next video. Okay, Josh, good to hear. The next video, which I'll do on Wednesday, which will be the bank recs. We're just going to do petty cash today, and also talk about internal control and fraud a little bit. So, but this is the purpose of an internal control system. Our question is, what is the purpose of an internal control system? And you see those answers, which are these 4 bullet points. Okay, so the purpose or the reason that we would do a internal control system is to protect assets, ensure reliable accounting, promote efficient operations, and also to uphold company policies. So that's the answer to your first question. The question is, what's the purpose of an internal control system? Those 4 bullet points are your answer: protecting assets, ensuring reliable accounting, promoting efficient operations, and upholding company policies. All right. So that's the first thing I want you to do when you get a chance, is go answer those that question 1 for chapter 8, which is on Blackboard in the discussion board section. Okay, so I won't spend hardly any time on this right now. This is, you see, it's got the word act here. So this is some sort of an act of Congress. The Sarbanes-Oxley Act, which is called SOX for short. Essentially, you had some companies that were doing some bad things, and the auditors did not, which is the people that are making sure the companies are not doing bad things, didn't do what they needed to do. And so there was a big revolutionary act here to try to fix that problem caused by those people that were doing bad. So this law requires the following for public companies. Public companies are those that are traded on stock exchanges. So you won't see. So this would not apply to like a Chick-fil-A. Chick-fil-A is a privately held company, essentially by the Cathy family, and so this would not apply to Chick-fil-A, but it would apply to McDonald's or Burger King because those are publicly traded companies. So this is our rules here. The law requires executives and board of directors must install effective internal controls. Auditors, that's those who check the company for correctness, must evaluate internal controls. Violators receive penalties. The auditor's work is overseen by an agency or an accounting board. A public company accounting oversight board would call that the PCAOB. Okay, so the PCAOB will provide oversight. All right, so this is also out of the textbook, principles of internal control. We want to establish responsibility, maintain records, ensure assets and bond key employees, separate bookkeeping from custody of assets, divide the responsibility for related transactions, apply technological controls, perform regular and independent reviews. Okay, so let's look at a couple of these. So here we go. Separate record keeping from custody of assets. Now, what does that mean? Okay, it might be kind of a worded as a complex thing, but in reality, it's not too overly complex. Let's think about somebody that's in charge of a warehouse. Okay, you have a warehouse full of maybe it's inventory. Okay, it's inventory that you're going to sell, and your job is to make sure that it's being managed properly. Okay, so what that would mean, if you're in charge of the items in that warehouse, then you should not be able to go in there and change inventory levels. You would not want to be able to go in and go into the records for the inventory and lower that number. Okay, because what could happen is, you could take some stuff home, which we call that embezzlement. In other words, you took some stuff home, but then you also went in and lowered what's in inventory so it still matches. Now, obviously, that entry would be fraudulent, and you could get caught. But if you don't have that ability to do it, then that prevents a little bit of that from happening. So we want to separate the record keeping from those who are in charge of those assets. And then down here, technological controls. Excuse me. Pollen's getting me a little bit. But so down here, applying the technological controls, the big thing there would be if you have a computer system, right? Whether it's an accounting system, okay, when you sign in, okay, then you're going to have limited areas that you can access. They call that a hierarchy approach, right? Whoever's in charge of the accounting, maybe this is CFO, whenever he logs in, he gets full access to all accounts, okay? But if you're in charge of accounts receivable, then when you log in, all you have access to is accounts receivable, okay? So you can use technology there to help limit people from making mistakes in the system. So this down here is what we call the fraud triangle, right? It's a little blurry. That's just because it's a low-res picture. I made it too large on the screen. But you see that there are three sides to this triangle. Okay, opportunity, rationalization, and down here, pressure. That doesn't have to always be financial, but it typically is. But financial pressure is part of this. So what we say is that all three of these must exist for fraud to occur. Now, on the flip side, it's really essentially impossible to eliminate any of these three. So there's always going to be a possibility of fraud. But what we can do, especially right here, is with a good system of internal control, this opportunity shrinks down. Okay, the more we can shrink it, okay, the less opportunity to commit fraud because we got good internal controls. Okay, the other parts are kind of independent of that. If we can shrink this to almost nothing, even if we have fraud, and even if we had financial pressure, we could still eliminate the majority of the fraud. Okay, so good internal controls will shrink this section of the triangle to a very low, very manageable amount of fraud in our business. Okay, so this would be the opportunity to commit fraud. This would be pressure to commit it. Maybe you had some bills, some gambling debts, some bills outstanding. It's not always something like gambling, which is kind of like, you did something wrong. It could just be that, you're married, you just had a child, and your spouse got laid off, and you got to feed the baby, you got to pay the bills. That could be, realistic financial pressure that is not coming from something like gambling or, drug habits or whatever. Then rationalization. Oftentimes this stuff starts off pretty harmless. You take a little bit of, you get paid on Thursday, you get paid on Friday, it's Thursday, you got no money, you got no gas in your car, you need some money. So you take $30 out of the register, you're going to pay it back tomorrow when you get paid, and because you got to have gas to get back to work, so you take the money, which is essentially stealing, right? But the next day, you know what, you pay it back, you feel good about yourself. Hey, I'm an honest person, I put it back. No victim, because I put the money back, everything's fine. That might happen for a number of weeks. Then after a while, you start saying, well, I worked pretty hard here. They owe me this money. I'm just going to keep it this time. And then at that point, you just become a thief, right? So honest people they get spun up into this fraud triangle through self-rationalization of why they're taking what they're taking. So there is a few limitations on these controls that we're talking about in terms of, protecting your assets and making the operations efficient. One is just the cost benefit. The cost of these controls must not exceed the benefits. This is good. This is important for really small businesses. I got a buddy of mine that him and his wife run out of their house like a driving school thing where you got to take your driving test. You got to have some hours in a car, and so it's just him and his wife in one car. And so there's nobody that they can separate their duties with, because it's not a big company. So for them, there's not going to be much internal control because it's just their little business that two people run. Whereas if it's a large corporation, then you want to have people that are, having separation of duties and not having any of this. The person with custody can't do the record keeping, stuff like that. But anyway, I'm not going to talk too much about internal control. We will have a couple of questions on the quick study, which will start here shortly. But for the most part, that's kind of it. The vast majority of this, the important concepts here is how do we do accounting for cash. And when we talk about cash, it's important to know, we're not just talking about green paper money in your wallet or in your purse. So here's some terminology. So we got cash equivalents, and some liquidity terms. The term liquidity, is the company's ability to pay for its near-term obligations. So if a company, the items we're talking about need to be able to satisfy those debts. Okay, so liquid assets are assets that can be readily used to settle debts. So for the most part, we're talking about checks. We're talking about cash, right? Now, look at this definition for the term cash, because there's a lot of stuff going on here. So you do have paper money, which is currency. You have coins, okay? You have deposits in your bank account, whether it's checking or savings. And down here you see checking account. You have savings account here as well. A check from a customer, okay? If you have a check from a customer, even though it's not been deposited in your bank account, because we expect it to be good, okay, we'll consider that as cash to us. Now, obviously, we gotta process it through the bank, but if a customer hands you a check, that's essentially like getting cash. Cashier's checks and certified checks and money orders. Now, these are a little bit different, okay? So these last three, you may not have actually experienced too much of. Sometimes it's kind of like a guaranteed check. So like if I write a check, you assume that I'm writing you a good check. With these here, it's a good check because it's backed by cash payment or it's backed by a bank. Okay, so a cashier's check. If you ever need a cashier's check, you usually can just go to your bank. They're usually free if it's from your bank. Sometimes they might charge you like $2 or $3. And what they'll do is they'll take the money out of your bank account and they'll write you a check that's guaranteed to clear. And then you can use that to pay some money if they require a certified check or, in this case, a cashier's check, right? Which is very similar to a certified check. It would be the same situation where they take the money from your bank account and they present you with a check that's guaranteed to clear. Now, money orders, most convenience stores will issue you a money order. I think the post office will too. It's kind of the same thing. You might pay it. They're going to charge a small percentage or a couple dollars, and they'll give you a check that's guaranteed to be good. Okay. Cash equivalents. There's not much involved to here. Usually, it's like some short-term investments that can be sold quickly in the stock market, and you get your cash pretty quick. Can be considered a cash equivalent for the most part. Not much going on there. Let's see. Let's skip this. And yeah, we won't talk about that. All right, here we go. Petty cash. So this is a snippet from the book. Buy low. What are you talking about? Oh, buy low will also do a money order, I guess. Well, I appreciate that. So if you got a buy low shopping center around you, you can go get a money order. All right, so petty cash. This is a snippet from the book. To avoid the time and cost of writing a check for small amounts, company sets up a petty cash fund to make small payments. I don't have an example. I probably should have done one. Essentially, okay, if I had a little box, okay, a little metal box with a little lock on it, that I can store in somebody's desk, right? Sometimes you might want to have a small amount of cash on hand in case somebody comes in or you just don't want to go through the whole process of writing a check. Because sometimes it's, if the person that's allowed to sign the check isn't there, then you got to wait the next day, and maybe you can't wait a day, and it's something small. I used to work at a CPA firm, and I remember seeing a petty cash transaction, so I'll explain it to you, okay? I was up front chatting a little bit, and I saw this old timer walk up, older fella. He had a bucket, he had a squeegee, okay? We had these big old windows in front of the building, okay? And he came in, he's like, we are talking about it. He came up with a bucket and squeegee. Yes, he came in and said, "Hey, I want to wash your windows." I don't know what he charged. We'll say he charged him $15, right? So, to help make it easier, they had some cash on hand. So they said, "Okay, man, we want you to do it. So go ahead and wash the windows." And when he finished, they gave him $15 of cash that came out of a little box, okay? And that's what we call the petty cash fund, or the petty cash box, if you will, all right? So what we'll do is we're going to have a small amount of cash in a box. Maybe it's in somebody's desk. Maybe it's in a little small safe. I'm not sure where it is. But that's what we call the petty cash fund, all right? If we have some small amounts that we need to buy some stamps. You need to buy, like in this case, some cleaning expense for this guy because he came in and he washed the windows. He did a good job for us. We gave him $15. Okay, we don't want to wait around. Wait around half an hour while we get your check ready. Instead, we can just give him the cash and he can go about his business. Anyway, so now this is just an example. So whenever they took the money out of that box and gave it to the person, they would have filled out something like this. Something that we know what it was for, okay? In other words, what you see on the screen here, in this case, they paid some freight charges, whereas mine would have been cleaning expense, right? And so because it's freight charges, we're going to apply that to the cost of inventory, and it was $15.05. So we would take the $15.05 out of the box, and we would put back in the box this receipt. Okay, so if we had a petty cash box that we keep $100 worth of change in, okay, and this transaction occurred where we took $15.05 out of the box. When I come back later to record what happened with petty cash, when I open that box up, okay, I'm going to see in there, let's see if I can do this math, $84.95 plus this one receipt, right? Does that make sense? So I open the box up. Inside there is not $100. Instead, there's $84.95 plus this one ticket. So what I need to do at that point is make an adjustment, right? And we'll talk about that here in just a minute, okay? So let's look at this. We love some journal entries, right? So let me get my board ready here. I had a triangle on here, but I forgot it was already my PowerPoint. I might have to get my screen a little bigger once I get this ready. So got my cash T, got my petty cash T right here. Yes, yes. So we're just going to do this example that we just did. Actually, we'll follow with the... Well, that's too many entries, though. We'll go back. My board won't be big enough. We'll use this one right here. Let's see. So we need merchandise inventory. Why do people keep calling me? It's all telemarketers or something. Okay. I don't like that. 1 second. Hold on. Okay. Alright, let's see what we got. Let me make something bigger too. We're going to use this example that's on the board though. It's probably going to be covered up. That's a pen top. Let me get this in here. Alright, big camera. You're going to love this, right? There we go. Alright. So this is going to be our accounts here. You see you got cash. We got, that's over here. Beginning balance, right? BB's beginning balance. We got $1,000 sitting in our cash account. Okay? So there is our beginning balance. And the first thing we're going to do is we're going to set up a petty cash account. We're going to take $100 out of the bank account and we're going to turn it into probably like, a 20, maybe 4 10s and a bunch of 5s, a bunch of 1s, and then maybe even some pennies and nickels and dimes and quarters. That's going to be $100. It's going to be in a little box, and we're going to store it in, somebody's desk, maybe the secretary, whoever it might be. Anyway, so the first thing we want to do is take $100 out of the cash account. Okay? So take $100 out of the cash account. That would be our first transaction. Okay, so it'd be a credit to cash. See that? Okay, then we're going to debit petty cash. Okay. So that would be our first to establish our petty cash fund. So number one there would be to establish a petty cash fund of $100. You see it? Oh, there we go. Establish a petty cash fund of $100. Got it? Good. Now, let's assume that what you see on the screen. Okay, so we'll say a month later. Okay, we don't worry about every time something comes out of that box, but at the end of the next month, we're going to go to the box and we open the box up. What's in the box is $84.95 plus this ticket for $15.05. All right. So when we open up that box, we'll see a $15.05 ticket, and that $84.95 remains. Now, what we need to do is this ticket here, we need to put it in its account, and we also need to replenish what's in that petty cash fund. Okay, so the petty cash fund always needs to equal $100. Right now, it does not. Okay, so this is how it's going to look, and it's going to look very strange at first. So we're going to add to inventory at $15.05. I keep making mistakes here. On my little board. And we're going to subtract. I keep making mistakes. Still making mistakes. Ugh. So this would be number 2, I guess. Okay, now look at this. This is going to look really strange. So look at number 2 here. Okay? So number 2, what you see, down in inventory, you see that we're adding that cost of freight to the inventory. We cover that in Chapter 5, Review 5 if you need to. If we are paying shipping for inventory, that means it's FOB shipping point, and the purchaser has to pay for the shipping. We add that cost to inventory. We discussed that 2 chapters ago, right? We skipped 7, so it's 2 chapters ago. I'm not going crazy. Now, up here. Well, hopefully you're thinking, well, what, the $85, I'm sorry, the $15 came out of petty cash, right? Why isn't it not over here? Does this make any sense to me? Okay? Because what we're doing is when we open the box, we notice that this was $84.95. Okay? We had to take $15.05 out of our regular bank account and put it back in here, and we just don't record that part of it. Okay? So, yes, it was removed from here, but we just want to show it coming out of the cash account, and from here it would, invisibly, I know it's going to be scary. Okay, when I take it out of this cash account, it's going to replenish this back up to its $100 level. Okay, I don't necessarily like that because it sounds kind of weird, but that's what's going on. So in theory, yes, you could do a credit here and this debit, and then you would do a credit here and a debit here, but it would be kind of a wash. So it's just easier to do it in one step as opposed to 2. So we'll take it directly out of cash, and this $15.05 is going back into this box to get it back up to its $100, what it's supposed to be. Okay? I wish there was a better way of showing that, but that's how it's going to work. Okay? So you see, the number 1, where we have a credit to cash, is when we establish the petty cash fund. Okay? And then when we'll have another credit to cash whenever we replenish it back up to its full amount. All right? Okay. Now, let's look at, this is going to come up later. Let's do it and look at it real quick. Let's see. All right. So, remember what number 1 was, right? We don't need the bottom anymore. So, the 4 possible entries that will affect petty cash, okay? Not whenever you record these tickets, but whenever you adjust petty cash. The first one you see here, which has a debit to petty cash, is when you establish a new petty cash fund. Okay? Now, sometimes you may say, well, $100 is not enough. Okay? After a year's worth of running it at $100, you say, well, we really need $300. $100 is not enough. So if you want to make the balance of petty cash 300 instead of 100, okay, then we would do this later. Number 2. Oh, dog's doing the bark. What the heck that was? That's someone outside getting the beat down. All right. So you see the initial. Establishment of petty cash, which is the $100 credit to regular cash, the $100 debit to petty cash. Hey, there's the dog's bark. Sorry. And now when we decide to increase it to 200, you see we increase it to 300, right? So you take 200 more out of cash, and now the balance over here would be these two added together, which would be $300. Okay, so if you, what I'm trying to get to here, if you, whenever you establish petty cash, you will have a debit to petty cash. If you ever increase the size of petty cash, you will also debit petty cash. Now, so let's say we got it to $300, but $300 is too much. Okay, we want to lower it to $250. So at this point, we would have to do a credit to petty cash and a debit to regular cash. Okay, so here our running total is $250. And hopefully you can see that. Let me try it one more time. My pen is really new and it's really juicy, so there we go. So number 3 would be if we were to lower petty cash. Okay, if we were to lower petty cash, you see that number 3 you have over here you have the credit to petty cash, and you have the putting it back into the bank account, so adding back to the bank account. Okay, and then our last thing here would be, okay, we decided we don't want it no more. We don't need this petty cash fund anymore. We're just going to use a debit card instead. I don't know, whatever it might be. So we would take that $250 that's still in petty cash and put it all back into the bank account. Now it's going to be looking confusing now. But the fourth entry, so entry number 4 would be that we decided to clear out or do away with eliminate the petty cash fund, so that remaining amount in there of $250 would be credited out and moved back into the bank account. Okay, I'm sure that was pretty confusing. But if you go back to it slowly, hopefully you can keep up with what I was going over there. Okay, so real quick here. All right. In this situation here, you see there was a $75 petty cash fund that they established it. That would be the entry. There's your increase to petty cash or decrease with the cash account. And now when you open the box up, okay, there was $71 worth of tickets. So there must have been what? $3.70 in the box. Plus plus 4 tickets. Excuse me. $3.70 in the box. Got the hiccups down. Plus 4 tickets. So whenever we record this, you kind of got it listed out here. You would debit miscellaneous. You would debit merchandise inventory. There's that 1505 again. You would debit delivery expense, and you would debit office supplies expense. Okay, and so that journal entry, which you see here, okay, here's that that journal entry. You see it right here. Debit the expenses. Remember, it comes back out of cash because it can come out of cash and just go directly into the petty cash fund to make it back up to $75. So we don't show any entries in the petty cash, just taking it out of the cash to put it back in the box. So I know that's confusing. That's the confusing part right here, because we're reimbursing. Okay. All right. Let's do a couple of these questions real quick. We're going to do like the first 4 or 5 of these. Then we'll be... this is quick study. Chapter 8 quick study. Starts off with some multiple choice questions. Now, whenever you get these as your homework, you're going to probably get some different ones. So you might have to do some research in the textbook. You're grown kids. You can handle that. But this is just some true false. I mean, you got to check your works. If you miss these, there's something wrong with you. But anyway, that's just... Obviously, I'm joking. It's okay. But separation of record keeping for assets from custody over assets helps to reduce fraud. That was on the list, right? if you're in charge of inventory, you should not be able to make adjustments to inventory in the system. So the separation of these is definitely will help reduce frauds. That's a true one. Number two, the primary objective of internal control procedures is to safeguard the business from theft from governmental agencies. All right, really, we're trying to safeguard from theft from our employees for the most part. So this is actually false. Number three, internal control procedures should be designed to protect assets from waste and theft. One of our 4 bullet points was, operating efficiency. And obviously, waste and theft will be a part of that. So that's a true statement. Then down here, separating the responsibility for a transaction between 2 or more individuals or departments will not help prevent someone from creating a fictitious invoice and paying the money to themselves. The reason that we do this is because that way you have to have 2 people working together, and that's going to be, hopefully one of those 2 won't be a thief or be in on it. Internal controls will never stop collusion, but in this case, if you had 2 people, if one person was honest, it would make it very, very difficult for the other person to do this. Okay, so let me make sure I get this wording right. Separating the responsibility will help prevent. So this would be a false statement because it says will not. Okay, so there's number 1. All right, let's jump to number 2. A couple more true falses. All right, a guideline for safeguarding cash is that all cash receipts be deposited monthly or yearly. Now, we would not want to have this big, gigantic amount of cash sitting in our safe. The guideline there would be essentially daily. We want to deposit our money daily, so this would be a false statement. The voucher system is a control system exclusively for cash receipts. Now, I didn't talk about this. It's in the text. Essentially, what a voucher system is going to be a line of paperwork that leads up to a disbursement of cash, okay? So, essentially, it's going to start with somebody requesting something purchased, and from there, it'll be a purchase order. Once you have a purchase order, you'll place the order, and there'll be some shipping documents plus an invoice, which is how much we need to pay. And once we have the shipping document, or sorry, not the shipping document, but the invoice as what we need to pay, then we can process a check to pay the invoice. Okay, and that is for cash disbursements. So this says cash receipts. That's cash coming in. So it's false because it should say the voucher system is exclusively for cash disbursements. So false. A guideline for safeguarding cash is to separate the duties of those who have custody from those who keep records, and that's what we just discussed earlier, so that's true. And then down here, separation of duties eliminates the possibility of collusion to steal an asset and hide from theft. So I just said it earlier. Internal controls will never eliminate collusion. So this will be false also. All right. Now this is cash over and short. Let me go. We'll explain this one here on the fly. Okay. So let me get my stuff fixed here. I'm going to use the board for this, okay? So real quick, I've got cash. I've got, in this case, was it sales? Yeah, sales. And I got cash over short. Okay. All right, so what we got here is for A, okay? So A, it says the cash register shows $420 worth of cash sales. So the $420 is our cash sales, okay? but the register says $430. So what we have actually in cash is $430. Okay, so here's our first one. Okay, look what we got. So if I were to record this, I would record the sales from the receipts of $420. See the sales. And my actual cash deposit is $10 higher. Okay, we don't know why. It's just higher. Okay, we're not going to research it. We're just going to go with it. So what I need is a place to put this extra $10 of credit to make this entry balance. And that's what we're going to use. This down here is this cash over short. So I need some more credit, right, to make this thing balance. So I'll put a $10 $10 debit. I'm sorry, debit. I said debit. Credit in there, so that this entry balances. So what is cash over short? Is it a cash account? Essentially, it's like it depends. It's okay. If it ends up with a credit balance, it'll be like a little miscellaneous revenue. If it ends up with a debit balance, it'll be like a miscellaneous expense. So let's type this in real quick. I can do this with one hand. Let's see. Okay. Cash. The cash will be what, $430. We'll do our over and short next. Cash over and short, $10, and then sales, $420. The pen's rolling around, it's driving me crazy. All right, so there's that one. We'll do a quick check. See how that's, we're not done yet. We gotta do B, but you see how it's correct, okay? All right, return to the question. Go on to part 2. Now that's the second one, right? So the second one, we've got the sales amount is $980 for number 2, but the cash amount received is $972. Okay, so when you look at the second one, we need a little bit more debit, right? We need $8 more of debit to get this thing to balance. Okay, so we'll put the $8 down here, which leaves us with a way down to about $2 credit to cash over short. So it's kind of like a little miscellaneous revenue. We don't know where it came from. It's only $2. Not gonna worry about it. Okay. All right. So let's type this in real quick. We got a cash debit of $972. We got our cash over and short. I like to put the cash over and short in the middle because it can either be a debit or a credit of $8. And then sales be $980. And there's those entries there, right? Nothing too difficult there. Okay, we won't do too much with the cash over and short. It is a concept in here. There are some really nice problems with it, but I think we're going to skip it for the most part. You should tell people to do a better job of counting the money. Make sure everything gets recorded. All right, that's fine. Let's go to number 4. Is our petty cash entry, okay? Okay, let's see what we got. Get the board ready in here. And we really need to, we'll use the board for the second part. So, this is what it says up here. We got Brooks Agency set up a petty cash fund for $150. And at the end of the current period, the fund contained $28 plus some receipts. Okay, $28 plus some receipts. So let's write these down here. We got entertainment. Okay, entertainment, which was $70. Maybe that was a dinner or something. Who knows? So we got postage, $30. then we got printing. And that's what, $22? Okay, so see, you got our, so that's our expenses that we'll do in our second entry. We'll do, we'll add $70 to entertainment expense, $30 of postage expense, $22 of printing expense. It says up there in the problem that there's $28 left. So left in cash. Okay. So just to kind of add to it, right, just to make sure there's no over and shorts going on here, you see right here, oh, I'll use the other hand here. Okay, so we had $122 in receipts. We've got $28 in cash still in the box, and those added together equals $150. So there is nothing missing. There is no over and short to worry about. So that makes this pretty easy. So the first thing we want to do is to establish the petty cash fund. This is where we will have a debit to petty cash and a credit to cash in the amount of $150 to establish that fund. So we're going to have petty cash, $150, cash, $150. So take it, remember, so look at that credit to cash. Take it out of the bank account and put it into a little small box that we can keep on our premises in case we need some small cash purchases, okay? And then number two, so at the end of the current period, we open the box up, okay? There's $28, and there's 3 tickets. We just discussed those on the whiteboard, right? You can go back to the video and look at it, okay? So let's list those expenses first. We got entertainment expense, $70. Postage expense, $30. My box and board saying printing expense. Couldn't remember. Printing expense of $22. Okay, those equal $122. Now we're going to take it out of the regular cash account, out of the bank account. We're going to take $122 out of the bank account, and we're going to put it back into that little box. So that box is funded back up to its full amount of $150, and we're ready to start the next period. So $122. When you get those tickets out and do the accounting, you do not affect petty cash. It comes out of the regular cash and goes straight to that box to bring the box back up to where it needs to be. Now there is some stuff down here at the bottom, okay? And it says here, identify the 2 events when you do a credit to petty cash. Now, I discussed these earlier in the video, so you can go back and review where I've got the 1, 2, 3, 4 petty cash, okay? Which ones they are is whenever you are reducing the amount of petty cash, which is this one, and whenever you eliminate the petty cash, okay? So, whenever you credit petty cash is whenever you either reduce the amount of petty cash or 2, eliminate the petty cash fund. In terms of increase, if you want to do a debit instead of a credit, that's whenever you establish it and whenever you increase it, okay? So there's that answer there. Okay? Looks good. Now, 5, 6, and 7 deal with the bank reconciliations, and I'm going to go ahead and just pick that up on Wednesday, okay? So our Wednesday session, we'll do bank recs, so make sure you're around for that. Don't forget, I'm going to go ahead and set the due dates for Chapter 8 to be this coming Sunday. Smart Book, Quick Study, which you'll be able to follow this video to finish, and then homework will all be due on Sunday. Feel free to go ahead and get ahead. The homework will be short because it's just going to be this quick study more or less with your own numbers. And also at that point, you can start working on the Chapter 4 Unit 4 assignment. The first parts of it will be Chapter 8 stuff. So if you want to go ahead and start on the Chapter Unit 4 assignment, the first problem or two will probably be something to do with petty cash. and you can go ahead and do that, guys. So until then, we will see you on. We'll see you live around lunchtime on Wednesday to do bank recs. Until then, have a blessed 2 days. Stay safe. Social distance, like they say. And God bless. And we'll see you on Wednesday. So long.